Now, I've got a great presentation to share with you today. It's been wonderful to see the rally that's happened from the lows over the last week, and I hope many people's portfolios have been boosted. There has been obviously a long bear market for a period, and valuations have been knocked well down. And I have to say, this is one of those patches where that happens in markets where, you know, valuations get very low, but actually it sows the seeds for the next bull market. And I think many of the lessons that you do here today, you should be able to apply in these markets, because what we find is that many of the greatest multi-baggers do come out from low valuations. Now, first up, is this webinar for you? This is going to be very much a webinar for private investors and who are stock pickers. This is very much more aimed at stock pickers rather than systematic investors. Now, many of you will know me as a systematic kind of person. I have always talked a lot about the benefits of data-informed and data-driven investing. And this has been a really fantastic exercise for me to work on this research. We've worked on this research as a team, and many of the insights have been really quite fascinating and remarkable, and it's completely upended some of my own thoughts on the attributes of certain shares. And I hope you get a lot out of this. What will you learn? Well, I hope you'll leave this webinar with a much clearer understanding of how to identify potential multi-baggers and the traits of multi-baggers, both quantitatively and qualitatively. Today's webinar, on the agenda today, are a range of things, and especially mastering the multi-bagger. So we're going to be revealing the top 10 stocks, the top performers in the UK stock market, based on certain criteria. And then we're going to dig into the anatomy of a multi-bagger, some of the portfolio traits and the quantitative traits, the qualitative traits, and also a checklist for helping you find multi-baggers in the future. And in this masterclass, we'll also be following on from this because there's so much material. It really is fantastic. We've got so many insights. We can't possibly share it all in an hour in a webinar. And I don't want to take up too much of your time. Todd Wenning, it's great to see you here. So we're going to be also following on. This webinar is open. It's mostly subscribers on this webinar, but we will be doing some subscriber-only follow-on material, a masterclass series, 3 videos, which will be on firstly, the financial engine of multi-baggers, then digging into competitive advantage and capital allocation, and then also how you can use all the tools and resources we have on Stockopedia to screen and identify multi-baggers. We will then also do a special webinar, which will be a dedicated Q&A session, and watch lists will come out in the new year, where we hope we will help identify potential multi-baggers of the future. And this shouldn't all just come from us. Please do share with us all your thoughts on what you think are the potential multi-baggers of the future. We are a community at Stockopedia. I'm very privileged that we have so many far better stock pickers than I in the UK stock market, and our terrific editorial team. So we hope we can actually create some great resources for you. So heading on, the joys of multi-baggers. So what is a multi-bagger? Well, Peter Lynch, in his absolutely essential One Up on Wall Street, said this quote: "In Wall Street parlance, a 10-bagger is a stock in which you've made 10 times your money." It's a really must-have read, and multi-baggers are stocks that go on from investing your 1 bag in a stock to 2-bag, 3-bag, 10-bag, and potentially even 100-bag. So we can see it in this slide. From a 1-bagger, you've gone up when it doubles in price to a 2-bagger, to a 5-bagger, to a 10-bagger. Now, this is a real share that I actually did not invest in way back in 2004. I instead decided to buy a share which happened to fall by about 90%. So that was a gold mining company. And if I'd known that then, what I know now, I would not have made that decision. And this stock not only 10-bagged, but after that 6-year period, it then went on to 10-bag again in the next 4 or 5 years, 6 years. So it went up to actually become a 100-bagger over a decade. And that 10 grand that I did not invest in this share had the opportunity cost of £10 million to myself. So we all wish we could find a 100-bagger, and I hope some of the lessons here will help you do so. So I want to dispel a few myths. And before I do that, actually, I'm going to say that I'm going to give you some lessons from this in one of the masterclasses, because this share actually ended up having quite a significant tumble. Now, I want to dispel some myths in this webinar about multibaggers, and I will come back to these again and again. Some of the myths that you hear will be that multibaggers are only to be found in trendy or disruptive sectors like technology or biotech. We all know of lots of tech multibaggers in America, and it's not always the case. There's also the myth that multibaggers tend to be expensive glamour stocks. And the third myth, that you need to invest in speculative high-risk ventures to find big stock market winners. And also another myth that quick profits are the goal with multibaggers. Now, I'm going to come back to these 4 points through this webinar. Now, who am I? Many of you will know me. I am the CEO and co-founder at Stockopedia.com. My name's Ed Page Croft. I'm a chartered financial analyst. I started my career at Goldman Sachs in wealth management. I trained as a scientist before that, and I take a very data-informed approach to everything I do. And, we provide a fantastic platform for our more than 10,000 subscribers at Stockopedia. And please do come and check us out if you aren't already a subscriber. And we do fantastic work. And I'm very privileged to have such a great community on the site. Now, quick disclaimer. You will, of course, see a lot of past performance in this webinar. Past performance is not an indication of future results. I know we all know this, but it's very important. Shares go down as well as up. We are not a financial advisor. This is educational only, informational only, but I hope you will learn a lot and apply it in your own investing. But if you're in any please do see a financial advisor if you have any questions, and but do talk to us on the site too. Okay, about this study. First of all, our methodology. We conducted this study very much on UK stocks. This is all stocks on the London Stock Exchange, including fully listed and AIM listed stocks. And we have a time frame of 10 years from the 20th of April to the 20th of April 2023, 2013 to 2023. This was the first date of our stock ranks and the first date of our archive database. So we thought we'd clip it as a full decade. The trading history, there was an active listing on that. All stocks had to have an active listing on the initial date and still be listed on the final date. Now, this means that anything that was an IPO in the interim or had delisted in the interim was excluded. In terms of size, a minimum market capitalization of 50 million on the initial date. And we actually have a slide at the end of the deck about the micro caps, but we found that the ones that multi-bagged had a median market cap of about 5 million. So we excluded them at the time because most private investors don't use them. Also, in terms of returns, we use split adjusted price histories and dividends were excluded. Now let's get on to understanding the top 10 stocks from 2013 to 2023. So the top 10 performers. First up, JD Sports. Please do say if you own JD Sports, and especially if you owned it for that entire 10-year period. It managed to do a 22 bag through the period. This is a retailer of sports fashion wear and shoes and so on and so forth. We all know it from the high street. Secondly, Games Workshop, a real big winner in the Stockopedia service for many of our subscribers. 14 bags, and they have a wonderful sort of niche product where everybody likes painting figurines and playing Warhammer and all those games. YouGov, which also has been a great multi-bagger, 12 times. They do all the kind of panels and polls for a brand index, for government, checking out the polls on the elections and so on and so forth. CVS Group, consolidator in the veterinary care market, more than 10 bags, consolidated that whole market quite considerably. Burford Capital, this is more of an outlier. They had a very unique business model and still do in litigation finance, doing very, very big cases. Now for the next 4 Imprint Group, almost 10 bags, leading seller of promotional products. They send us these brochures all the time to try and get us to buy branded goods for our business, branded pens and so on and so forth. And they've done exceptionally well in America, and they've got a foothold here as well. Very fragmented market. Judges Scientific, also an acquisitive group in scientific instruments, and they design them, they manufacture them, et cetera, et cetera. Another big holding in the private investor community. Jet2, offers scheduled flights, package holidays, and so on and so forth. This was known as Dark Group and was actually ranked as 100 out of 100 in our stock rank system at the start of the study. A really great winner for the community and a very, very big long-term multi-bagger. SafeStore, we all buy too much stuff. It all ends up in storage. SafeStore, the biggest performer of that industry. Lock and Store did very, very well too. Great, Viv Fleet. You've held 5 of these. Well done. Renew Holdings, engineering services. They work in regulated markets, and they've done a lot of acquisition across a diverse range of businesses. So that's the top 10 performers. We will be actually sharing this deck with all of you, I hope, tomorrow. And there are a lot of slides that you can actually go and dig into at your own leisure. But I want to crack on because we had that technical glitch. The anatomy of a multi-bagger. I like to do this we do this in all of our studies. We've done it on profit warnings. We've done it on IPOs, and we're going to dig into some of the data. First of all, taking a more of a portfolio view. So the aggregate share price performance, I posted this on Twitter yesterday. Please do follow me there on @Ed Croft. And you can see here that by starting a portfolio equal weighted of all of them, it's gone up more than 1,000%. And this is really a FOMO chart. This is what I wish I'd done. More than 1,000% on your portfolio over 10 years would be a great, great result. And as you can see, it was a very smooth ride, but there have been corrections. 2018, the pandemic, the whole portfolio fell by about 50%. And then it rocketed, almost tripled over the next few years. And again, in this bear market, has declined again. So that is really the overview of that portfolio. And in terms of the individual share price performances, we do have slides on each of them at the end. But you can see here, this is JD Sports Fashion, quite a volatile ride, but doing exceptionally well. This light blue line is Burford Capital, which was leading the whole pack and was very, very popular in the investment community until there were huge short selling reports released, and then it crashed. And it's recovered somewhat and still has some big cases it's working on, but it's quite a Marmite stock for a lot of people. And of course, all the others are there in the mix. So generally, very strong performers through that whole period. But this gives you a bit of an inkling of kind of the volatility of the shares through this period. And let's go on to the next slide and see the volatility. Okay, so in terms of share price volatility, this is the average volatility of the shares in the portfolio. You can see a real hump here in the pandemic because they all sort of crashed. But generally, the average volatility was sort of 25 to 35%. And that is pretty standard for most shares in the market. But many speculative shares are way, way, way more volatile. This pink line shows the most volatile share in the set and the blue line, the least volatile. So, these all had a wide range of volatility, and that can really shake people out through time. And being shaken out of really great stocks is one of the real worries in the market. When they fall, it can really sort of scare you and get you out of them. And you've got to kind of keep focused on, what the qualities of these stocks are. And really also, because they're volatile, there's always a chance to actually buy them and buy them at a little bit of a knockdown price at various times. And this is an analysis which illustrates that they all had significant drawdowns. So there's always a chance to buy. Here are the names of all of the different stocks, and here is the maximum drawdown that they had throughout this entire period. And the maximum drawdown on average was about 62%. So throughout that period, this does include the pandemic, there was always a time to buy. Now, I actually excluded the pandemic here as well, because before the pandemic, there was also an average 43% decline across all these shares. So, quite significant corrections in most of these shares. So there was always a chance to buy them. And if we look at the sector contribution, we can see that there's a skew towards consumer cyclical sector. So we categorize all shares across one of 10 different sectors on Stockopedia: consumer cyclicals, financials, basic materials, healthcare, defensives, utilities, industrials, energy, technology, and telecoms. Now, the little gray lines here are the weight in the sector, in the FTSE All Share, the index, whereas the colored lines are the weight in these top 10 stocks. So a very strong weighting towards consumer discretionary shares. And actually, one of these financials is SafeStore, which is a REIT, a real estate investment trust, which you could consider a consumer stocks too. So lots of consumer-facing companies here, and also lots of industrials. Even in healthcare, many people like biotech stocks, but this was CVS Group, which was the consolidator in the vet market. So quite interestingly, there were no tech stocks in this list, which is particularly interesting. So whereas in America, you'd find lots of tech shares in this kind of multi-bagger analysis, but in the UK, very, very few. And I think this is really, really interesting. So let's dispel one myth. Multi-baggers are only found in trendy or disruptive sectors like technology or biotech. It isn't actually true. What is true, multi-baggers often emerge from seemingly mundane or traditional industries rather than the industries of the future. And I think that's a really key insight, and one that we should all remember. Now, in terms of the listing, at the moment, 6 of them are on AIM, the alternative investment market, which is the more junior end of the London Stock Exchange. And on the main market, there are only 4. And I haven't researched this, but I think 1 or 2 of them may have been promoted when they went on these trajectories into the main market. So do bear that in mind. If you're not looking on AIM, you may be missing out on some multi-baggers. So let's move on. The quantitative traits of multi-baggers. So I've done a little bit of a dive into some of the data, and I'm going to shamelessly use our stock ranks framework because it's very, very easy to understand for the first part of this. So most of you will know that we do analyze and rank all stocks according to what I call the QVM framework: quality, value, and momentum. And so good profitable shares do tend to beat junk shares, cheaper stocks tend to beat expensive shares, and higher momentum shares that are strong share price and so on tend to beat weaker shares over the long term. And this is very much academically proven and by our stock rank system. So in here, you're going to find more profitable shares with stable and growing margins, free cash flow generators with lower chances of bankruptcy risk and higher earnings quality. For value rank, we actually use price to earnings, dividend yield, price to sales, common ratios all bundle up into that ranking. And for momentum, we use the share price strength. Counterintuitive, I do know, but actually shares that are going up have a tendency to keep going up, whereas shares going down have a tendency to keep going down. And we also use earnings momentum in this as well, which is how much brokers are having to upgrade their forecasts and whether the company is beating those forecasts. So that's a kind of general theme there. I like to reiterate that. And we publish these on all stock reports in this great little widget. And really, this is the fundamental essence of my own investment strategy, is just using these numbers. So we equal weight the quality, value, and momentum ranks into an overall blended stock rank. And they're all ranked from 0 to 100 as percentiles. So at the top, you're going to find, a 100 rank share is going to be good, cheap, and strong. Now, that was Jet2 at the start of this study. It had a rank of 100 at the very, very start of the study. So this shows you all the data in 2013 for all of these ranks, the quality, value, momentum rank, and the stock rank as a whole. And Jet2, as you can see here, had a rank of 100. Now, we analyzed all of these traits for all the stocks, but before I talk about the ranks, do note here the market capitalization of on average, the median of all those stocks was 168. They range from 55 million for Renew, all the way up to JD Sports at 358. And so they were all small caps. The average stock rank was 86 out of 100. Now, that means that they were higher ranked shares. They were in the top 14% on average of the market. And the quality was very high, 83 out of 100. So very generally profitable shares. And interestingly, the value rank was 77. That means they were in the cheapest 23% of the market. If that number is very low, it means they're expensive. So actually, they were actually more like value shares at the start. And they had quite strong momentum. So the share prices were generally performing and they were beating estimates. If I roll on to 2023, so this slide now shows the 2023 numbers, you can see in terms of market cap, JD Sports has grown to 8.5 billion. The average market cap is more around 1.7 or 8 billion. And the stock rank has fallen a little bit, but the quality rank has grown up to 88. But interestingly, the value rank has actually dropped to 23. That means they've got a lot more expensive. So the market has recognized the quality in these companies and the growth and has put them on more premium valuations. And this is probably better illustrated on this slide, which shows these 3 ranks over time. So the value rank here is in green. Notice how the valuation was cheaper at the start, because 80 is a cheaper value rank, and it became more expensive over time. So that's the value rank dropping, so they became more expensive. But the quality in blue actually grew through this period. So they became even better quality companies through the study period. And I think that's such an important facet here. Not only have you got very good profitable companies, but you've got them actually becoming more highly valued by the market. And so if I just summarize this, I won't be talking much about the ranks anymore, but from 2013, you've kind of got this fingerprint of a share. It was a small cap super stock on average, and they grew to be mid to large cap high flyers, more like growth shares with a value rank that was much, much lower and a slightly lower stock rank. So I think that's really, really interesting. And here's my next multi-bagger myth bust. Multi-baggers tend to be expensive glamour stocks. Not necessarily true. Multi-baggers often start at moderate valuations, even as value stocks. So, if you read the small cap value report that Paul and the team all write, that is the kind of area of the market where you're most likely to find multi-baggers, certainly in the UK market. And so let's move on. Conscious we lost a few minutes there to the technical glitch. We're going to look a little bit more at the quality of each of these companies, and we're going to look at some financial ratios. So first of all, the return on capital employed. These companies had consistently high profit engines. So this chart shows the return on capital over the 10-year period. And return on capital really is, you can think of it as a kind of operating profit over the capital employed in the business, the debt and equity in the business. And we found that they sustained an average return on capital of about 16% through the study. And, it dipped in the pandemic, but generally sustained very, very high. And growth companies that can retain their profits and invest that capital into their enterprises at compounding rates can really create stellar returns. So let's look at the margins. And I thought this was really, really interesting. So the operating margins started actually fairly low, 3.5% at the beginning of the study, and they grew up to being about 12.5% by the end. So a lot of operating leverage here. You found that these companies were able to sort of grow their sales and actually get higher profits over and over and over the period. So they were able to have some scale economies through these businesses. And so always look at the operating margin. Is it growing? Have they got room to expand it? That's very, very important. Now, the other thing was debt. So a lot of companies are debt financing, and the balance sheets are such an important aspect of investing, especially in higher interest rate environments like we have at the moment. But we found that these companies use debt quite sparingly, if at all. And they had quite a lot of strong free cash flow generation. And that means the net debt to equity, which you can see here is on this axis, was actually, they had a lot of net cash. So it's below zero. They had net cash, not much gearing. So, but it grew through time, perhaps as they were making more acquisitions, perhaps also during the pandemic, some needed to borrow some money to get through that tricky patch. But the overall net debt to equity was generally very low. At the max here, on average, it was about 20%. Only 4 companies had net debt in year 1. So quite interesting. And I think that's a really key insight. Jim Slater, I always love his books, Beyond the Zulu Principle here. He always said he loves stocks that had net cash and that were able to spit off a lot of cash flow. Some of the other things that I've got in the slide deck, but I'm not going to show now just for time purposes. These companies barely issued any equity. So they had very low dilution, and they also had very conservative accounting. So they generally had generally had a lot of free cash flow. And I think that's really, really important to understand, because you want free cash flow generators. So here's another myth bust. You need to invest in speculative, the myth is that you should invest in speculative high-risk ventures to find big stock market winners. But the truth is that multi-baggers often have sustainably profitable business models before they make their multi-year moves. So I think, everybody on Twitter is always, they were in the pandemic, talking about all these very, very highly speculative companies. But actually, these multi-baggers do show that actually it was profitable enterprises that actually did so well. So let's have a look at the growth. So as you'd imagine, these companies were growing quite well. They actually began on quite moderate sales growth, but well above inflation. And the sales growth grew and grew and grew. And we found that they maintained a high rate of about 12%, typically throughout the decade. The only slowdown was in the pandemic, as you might expect. And that sales growth was converted into earnings growth really quite effectively. So the earnings growth here, this is the median across all the companies, was sustained at about 20% annually through the period, a bit more volatile. Quite a few had losses for some reason in the growth declined in 2015, not losses, but that just means that profits are falling rather than actually necessarily net losses. But you can see it was actually at a much higher earnings growth rate than sales growth. And I think this is quite an important point. And I've got a little illustration here using Games Workshop as an example. In blue here on the left axis is revenue. So revenue. And the revenues, as soon as it took off in about 2016, 2017, it really took off quite strongly in terms of revenue. But look at the operating profit in red. It started much, much lower. And then it escalated much, much more quickly than revenues. And that's operating leverage that's happening right there. They're getting more and more and more profits for every revenue pound of revenue that comes through the business. And I think that's something always everyone should look out for in stocks. Do they have that capacity to kind of keep their fixed costs, a bit lower as they kind of scale their revenues? Because you can really get outstanding earnings growth in companies like that. Now let's dig deep into the value ratios. So I'm going to keep this quite light. I've got more information in the deck, but let's look at the PE ratio. It started fairly moderately and it grew through time. So we found that the PE ratio started on about 13.3 times and they ended up at about 23 times at the end of the study. So, these companies were bid up. They almost had their valuation ratios doubled through that period, which was quite interesting. And at one point, the PE ratios ended up at on a median of about 40 times, possibly because earnings declined in the pandemic. But I think that's a really interesting point. I've got a little slide here, which gives you a bit more intel. So this is all 10 of the companies. And the light green bars here are the PE ratio using historic data. And the dark green is using the forecast data. So yes, 3 of the companies had quite high historic PE ratios, and they were already recognized as growth stocks: YouGov, CVS Group, Judges Scientific. But actually on forecast ratios, they were all quite moderate, whether you trust the broker numbers or not. And actually, they were all 15 or lower. So the average PE ratio on forecast basis was under 12 times. And remember, back then, the valuation of the market was a lot higher. So now we're seeing a lot of companies on low single-digit PEs. And, I think back then, these were all a bit moderately higher because the whole shoal of fish of the market was a bit higher. But I think also this kind of reiterates that these companies are, a lot of them are value stocks. And this is one other point on the price to tangible book ratio. This is a bit geekier, but these are quite capital-light companies. And a lot of them didn't have that many, sort of fixed assets and tangible book value, but also the market started recognizing the value of their intangibles. So, companies like Games Workshop have a lot of kind of brand value and a lot of intangible assets in the business. So the market started bidding those up to higher and higher valuations. And this next slide, I think, is really interesting. So in terms of dividend yields, all 10 paid a dividend at the start of their journey. Some were cut in the pandemic, it's true, but they all paid dividends. The starting median dividend yield was actually 3%, and but they fell and fell, and not all earnings were paid out as dividends. So actually, they're more like 1% payers now. But I think this is such an important point, and it might be cultural in the UK that you could question, should they have paid dividends at all? Could they not have used all the capital in the business? But they paid some of it out to investors. And I think there's a lesson from Jim Slater here. He said that most investors prefer growth stocks to pay dividends. There are some funds that do not invest in companies unless they pay dividends. We do have a lot of pension funds in the UK. We've got a more conservative investment community. They do like dividends, but also dividends are a sign of kind of, capital discipline in a company. So, don't just discard dividend payers. I know it's kind of, in America, barely any dividends are paid and they just do share buybacks. And interestingly, on the buyback point, we didn't find evidence of buybacks in these companies as a whole. They were generally, we didn't find too much evidence of share buybacks. As they mature, I'm sure they will, but in this growth phase, they didn't seem to. So anyway, Great to see so many of you who have done very well in these shares. I'm going to look now at some of the momentum indicators. So share price strength and earnings strength. So most of these companies, as you'd imagine, were beating the index. They had consistently strong share prices. So this is the relative strength against the FTSE All Share. And this is a percentage chart that shows how much the shares on average were beating the market. And I love using this measure when I'm screening the market because I want to find shares that are showing strength. And these stocks were outperforming the FTSE All Share by 24% on average per year. There were corrections, but they were rare. And actually, it's a trait I always say to everyone, do become accustomed to buying at new highs, buying breakout stocks and more. So, it's really important. If you find great businesses, being too sniffy on a knockdown in share price actually can stop you from buying great winners. And there are these golden words, which I love to see, we all love to see in trading statements. This is one from Games Workshop, ahead of expectations. You want to look for words like a significantly ahead of expectations in trading statements. We found that multibaggers were 8 times more likely to report ahead of expectations than behind expectations. There were 2 or 3 profit warnings amongst these stocks. And Judges Scientific actually in 2016, I think it was, had a couple of profit warnings. But look at all these times when it exceeded expectations. All of these moments when it actually announced it was exceeding expectations all the way through. And you see this theme across all of these 10 stocks. And it's such a theme in all of these multibaggers. So do read the RNSs. Aston Girl, I know it's your favorite expression. I read this on Twitter very, very regularly. Do follow Aston Girl on Twitter. Rebs, great to see you on the call. Now, interestingly, why are they able to say they're ahead of expectations? And I fundamentally believe one of the reasons is because they are so barely followed by the investment community. We found that many of these companies had low institutional coverage. And low analyst coverage. So at the start of the study, they did have some coverage. So on average, we found they had 3 analysts following them. But that's kind of below many institutions' radars. And through time, the number of analysts following the companies more than doubled. And that is such a kind of a great thing for private investors because so many institutions, they don't buy small caps because they're under the radar. And it really gives such an advantage for private investors. So, if you're doing your research on stocks, just remember that the analysts may not be up to scratch on what's really going on in the stocks. You probably do have an advantage. And because they're often behind on the analysis, you find that these stocks have consistent earnings estimate upgrades. There's that wonderful little chart on Stockopedia I'll share in one of the masterclass sessions, but which shows that trend in the forecast. You want to see them trending up. These multibaggers consistently had their earnings estimates upgraded by the analysts. They're constantly ratcheting up, trying to keep up with these really fantastic businesses. So, do keep an eye on earnings estimate upgrades because it's a real indication that a stock is kind of going places. So that's kind of the point. The only time they downgraded estimates on all these stocks was in the pandemic, but that was because of, we know what happened in the pandemic. Right. That's all on those kind of fundamental traits. There's more in the deck. We will send them out. And I'll go a bit deeper into things, but I'm conscious of time. And I want to crack on to the qualitative traits of multibaggers. So first of all, I'm going to do a masterclass on this, going to go a lot deeper into this material. I'm having to kind of breeze through a lot of material because I'm conscious I don't want to take up too much of your time. But I want to look at a few business model themes. So first of all, it's very common to see simple, scalable business models. If you have a simple, scalable model, you can get a lot of operating leverage in your business. That's great for profits, great for multi-bagging. So a couple of themes here. Firstly, a replication of omni-channel retail. So there were quite a few retailers in here, and you see that time and time again. It's something that Jim Slater always looked for, the clonable business model of a retailer. They can take something and they can actually kind of replicate it again and again and again. JD Sports has been very successful here, acquiring lots of businesses abroad and lots of sort of small shops and so on and so forth. Games Workshop also, they do this extraordinary thing of doing one-man retail shops, and they also sell through trade and online. So this omni-channel retail theme has been a great, great growth factor for many, many businesses. These are the ones who are location-oriented. I call them needs providers. We all buy too much stuff. Safe Store, everyone has to store them somewhere. And CVS Group, a little bit more controversial, but they have consolidated a lot of the vet market, veterinary surgeries, crematoriums, and that kind of thing. So, you can see there's a kind of a location thing going on here where, there aren't many alternatives. And there's other simple scalable business models like Jet2, low-cost operator in a growing market there, and also taking market share from others, package holidays. And for Imprint, it's a really fantastic business. And, they really have been able to scale up from one distribution center in America, and they're also in the UK with these promotional products. And YouGov, they have they do a lot of kind of databases and obviously all their polling and paneling, and they've done some fantastic work over the years, and it's been a terrific winner. So that scalability is really important. And onto the next slide, you also see that there are, and you see this a lot in kind of more unique business models like specialist niche markets. And Judges Scientific and Renew both took this kind of horizontal acquisition approach in very, very specialist markets. And they were able to sort of, create highly profitable, high margin businesses there. And so that's Scientific Instruments in Judges Scientific's niche, and in regulated engineering infrastructure for Renew Holdings. So I think that's a really good place to look at. Many people don't look at these sorts of businesses because they always want glamour. But actually, there's so much to learn here from these business models. And an outlier here, Burford Capital, litigation finance. So quite a unique business model, but so unique, I'm not really sure if I can draw any other conclusions there. But there are some other litigation finance specialists on the market. Now, the one thing that Warren Buffett would always talk about is competitive advantage. And competitive advantage is really the moat that a business has around its business. A truly great business must have an enduring moat that protects excellent returns on capital. And that's from Warren Buffett's 2007 shareholder letter. And he's talked on this theme for decades. And he's probably the very, very best at this in the world. And I'm not pretending I'm an expert on this, but there are a range of really good readings on this. I'm going to talk more about this in that masterclass session. But these are 7 competitive advantages that come from the great book called 7 Powers. And I think this is one of the best frameworks for understanding competitive advantage. And so I'm going to quickly breeze around this. Branding, network effects, we all know Facebook, LinkedIn, that kind of thing. Scale economies, as businesses grow, they get more scale and they get more better unit costs, better ability to procure things at cheaper rates, et cetera, et cetera. Switching costs when you're locked in and you can't change. And we all know that from software we install, operating systems, that kind of thing. And it happens in businesses too, when they can't really switch from a provider. Think of Judges Scientific there with, very specialist niche products with kind of pricing power. Process power, many companies have got their own very specialist processes, which can be very, very powerful and hard to replicate. Counter positioning, think of Netflix against Blockbuster. When you have a counter positioning business model, it can really, really shake up an industry. Whether it's sustainable is another matter. I'm going to talk about that in the masterclass, because I think this is possibly one which is often comes under threat when established players move back into an area. And cornered resources can be anything from IP, specialist IP, or even specialist staff in an area. You can think of there are many businesses that even location where you've got like a quarry or something, less scalable, not necessarily a multi-bag kind of idea, but those cornered resources are very valuable. So I'm only going to dig into one of these now. The power of branding. It's so important. It really does create such an excellent moat around a business if you can do it well. Customer trust drives repeat business, less price sensitivity. And some of these might be a little bit more questionable, but JD Sports, such a well-known high street brand now, Games Workshop in its niche, YouGov for businesses that use that. And also they have very, very wide consumer recognition too for their polls. Jet2, if you jet off on package holidays, they're very, very popular. So 5 of the 10 multi-baggers had strong brands. I mean, I'd even say that, that there are sort of smaller kind of brands, less defensible in stocks like 4imprint in their specialist SME focus. Now, I'm going to talk about other ones, as I said, in the masterclass, but that just gives a taster. Also, acquisitions. Now, I found this really enlightening. I thought this was so interesting because I actually had always been a bit skeptical of acquisitive businesses. And have always been aware of, Teledyne, Henry Singleton in America, or even Warren Buffett. You could say that he's running the biggest conglomerate in the world. But many of these companies use acquisitions so creatively to drive their growth. So this is just looking at all of the regulatory news announcements. We counted 16 acquisitions by JD Sports, 14 by Judges Scientific in the study period, 11 by Renew, 7 by CVS, 4 for YouGov and SafeStore. And this consistent acquisition approach really, really drove a lot of the growth. This is very, very earnings enhancing. And you have to be very aware. One thing that Peter Lynch said is you've got to beware of empire building diversifications. I love that word, diversifications. If a business acquires a business in a completely different domain, that's a big, big red flag. They've got to stick to what they know best. You actually want to see them divesting bad businesses as well. So, and also many of these, these were just RNSs. But for example, SafeStore was always acquiring little units here and there that they would report in their annual report. So it's a really this has really kind of opened my eyes a lot and to some of the power of this as a growth technique. But obviously you need very, very good management. I will talk about this more in the masterclass, but quality and stability of management is so important. There are often owner operators in businesses who have got skin in the game, vision and passion. That's Stephen Shakespeare at YouGov, and also outsider CEOs who bring new perspectives and skill at capital allocation. So Kevin Roundtree, Games Workshop, he was actually hired as I think a junior finance person in the 90s, and he grew to be CFO, COO, and then CEO. And outsider CEOs who are really good at the numbers especially can be very, very, very effective. So, always checking out the management, understanding them, and seeing if they're sustained is very, very important. Okay, if I got the photo wrong, I'm sorry. I took it from the Games Workshop wiki. So we'll repair that in the if that is the case in the deck that we send out. Thanks for letting me know. So hang on to multibaggers. Now, selling is one of the big things. I think many of us will have owned many of these. We will have known many of these or even owned many of these over the years. And many of us would have sold them. And I've owned quite a few and sold quite a few. So, I hope some of you are held all the way through this. And I think this is a key lesson here, is resisting that temptation to sell. If you do own a classic multi-bagger, there is often a reason to sell. Don't do it. If they really do have all the traits and no change in the business model, and you think they can continue to power on, then not selling is a really, really valuable thing to do. So run your winners. You can't multi-bag if you settle for a double or 30% or whatever. Also, don't sell on good news. And this is something I've done in the past. I bought Domino's in 2004. In fact, I bought it in two different portfolios, one for the family and one for myself. In my personal account, I sold it when it doubled. In the family account, it 14 bagged. And I think there's a lesson there. It was beating estimates, and it, the valuation got ahead of itself, and I sold and regretted it. So you've got to let the PE multiple expand. So don't sell when it gets expensive. You've got to learn to enjoy premium quality. If you buy cheap, let your unpolished stone become valued as a diamond. Diamonds are indeed expensive. And, if you buy these things on cheap PE ratios, and especially at the moment, if they're on PE ratios of less than 10, are you going to hang on to them if they go up to PE ratio of 30 or 40? And if there's no change in the business model, etc., then it's something you really need to think about. They can get ahead of themselves. Of course they can, but timing a sale is very, very difficult. So don't sell when others do. Every share has a reversal. Ask yourself, has the story changed? If it has a scalable business model you trust, then it can grow through market weakness, and it can grow through any sort of natural correction in the share price. So that's really important. Now, the cost of selling a multi-bagger. Now, this is the annualized return through this decade for three classes of shares. The FTSE All Share at 3% annualized. The 90-plus stock ranks, 11% annualized. I think they've been terrific. They've had terrific returns over that period. Very, very happy with the high-ranking share performance. But look at the top 10 multi-baggers, 27% annualized. Now, let's take any one share that you own of this set. And if it's gone up 27%, you may well feel like you should sell it. Banking that 30% or so it feels like a good result, especially in bad markets. But the opportunity cost is really, really significant. if you look at this chart and remember these different numbers, this is what they look like in terms of the compound return. And this massive jump in the multibaggers, 27%, 27%, 27% for a decade, leads to 1,000% return. That's the opportunity cost of selling for a 27% return. The 90 plus stock rank, still great return, 170%. The FTSE All Share, only 30%. So anyway, there's a lesson there in compounding. It really does kind of work. And that goes to my next myth bust, that quick profits are the goal with multibaggers. No, they are not. It requires patience and a long-term mindset to truly realize the compounding potential of a multibagger. And I think one always needs to dwell on this. We always want to be doing something. We've got an action bias. We always think we can outsmart the market. But I think there's so many lessons here, and I'm trying to learn them myself all the time. Now, of course, multibaggers do eventually, many go on to 100 bag. Well, I wouldn't say many, some do. But some multibaggers can go wrong. This is actually the share that I was talking about earlier, that actually fell by 95%. It 100 bagged, and then it sold by 95%. I'm sure some of you will join the dots on which share this is. I'm going to use this as a case study on selling and on moat factors when I get round to doing these different masterclass series. We're going to be releasing one every week over the coming weeks. So, and we'll be sending them out to you. So anyway, a checklist to wrap this up for finding multibaggers. I'm going to share with you, firstly, some qualitative traits of potential multibaggers. So rolling up some of those ideas I shared, scalable business models, look for simple scalable businesses, look in favorable industries that might have simple scalable business models, media, retail, software, or often rather than hard asset firms. I'm really, obviously a lot of these companies did have a lot of tangible assets, but, there is a lot of scalability in certain parts of the market. Look for consistent operations, prefer businesses with a proven operating model. Look for competitive advantage. Look for brands, niches, network effects, or others of those 7 powers. Look for smart capital allocation. Look for earnings enhancing acquisitions, not diversifications. Look for something new. Jim Slater always used to say it. New management, acquisitions, products, they can often catalyze improvement in companies. And also look for positive surprises in trading statements ahead of expectations. Now, you can get a lot of this from regulatory news announcements. It's a great hobby for many, many people, and it's where a lot of insight into stocks comes from. You can really get ahead of the market. And looking at the quantitative traits, here we go. Look for a stock rank greater than 82. These are based on about the kind of 3/4. I tried to sort of create criteria that would capture 3/4 of each of these 10 shares. So look for a stock rank greater than 82, greater than 85.90 on breakout. Look for small caps, market cap from 50 to 350 million. Look for strong profitability, return on capital greater than 10%, which grows over time, quality rank greater than 75, often a lot higher, and room for operating margins to grow. Look for low debt, preferably low or no borrowing, net gearing of less than 30%, ideally. Jim Slater said always less than 50%. But I actually think in these shares, they had a lot less debt than I was actually expecting at the start. As I said, they had net cash on average. Look for high free cash flow as well. You want to see earnings being converted into profits. Cash conversion is so important. Moderate valuation. The PE should have room to grow. It's such a key driver of long-term multi-bagging returns. Forecast PE of less than 15 if there are estimates, but also a PE of ideally less than 15 on historics. But if it does have a higher PE ratio, make sure it's got really good earnings growth. Yield payers are fine. You don't want to be paying a high yield, though. You don't want a 5% yielder. Interestingly, you don't want really expensive stocks, and you don't want really, really cheap stocks. So it's probably, a lot of people do go into deep value investing, but actually we found with multi-baggers, they're rarely found in that deep value bucket. And also they tend to have strong sales growth, certainly well ahead of inflation. We found they generally had 10% or more trailing sales growth. And even if at the time they didn't have that much earnings growth, they had forecast earnings growth. So, as I said, if there's room for the margins to grow and they've got the sales growth and they've got high return on capital, then as that, competitive advantage comes through, the earnings can really explode. We saw that in quite a lot of these companies. Look for strong prices. Share prices are often a leading indicator that something is going on in stocks. So look for good relative strength above 0, ideally above 10%. And don't be afraid if a share price has beaten the market by 20% or more over the last year. And also, avoid highly dilutive companies that issue a lot of shares in the market. Now, I know that there's more and more push to get private investors in placings and equity issuance, but actually the very best companies don't really need that much new capital. So anyway, those are the lessons. Now, if you actually screen on these criteria, and I did it this morning on Stockopedia, you will find if you use all of those rules, no results, okay? And that is not a failure in screening. That just means that you have to have more nuance in your approach to finding multibaggers. And this is why I'm going to dedicate an entire video on this. I'm going to go into this in some depth and talk about all the ways that you can actually sort of start finding multibaggers in your stock screens. You actually have to use looser screening criteria and from different approaches, and also be kind of open to finding shares that might have higher or lower valuations. They might be turnarounds, there might be a few high flyers, and in the mix. So I'm going to go into this in some depth in due course. Now, we are dedicated to trying to help you find multibaggers, and that's why we've got this whole sequence of events coming up, which I think will be very, very interesting. So we've got this masterclass series coming up, and I want to just give you a little bit more insight into what's coming up. These are going to be subscriber only. So as I said, vast majority of you are subscribers, but if you're not, do join us. You will get access to all of these materials. So next week, I'm going to be doing a video on identifying the financial engine of compounders. That's a more of a deeper dive into some of those quality measures and also how this engine really works. I'd like to help everybody understand what's really going on there when companies reinvest their capital and are able to continually grow their operations. And that's why simple, scalable businesses are so important. And I'm also going to talk about multiple expansion. If you don't know what that is, do join that session. In video 2, we're going to talk more about competitive advantage, management, capital allocation, and also signs that it might be the game is up. I'm going to talk about that share with those charts of that 100 bagger that lost 95% and others. And then we're going to talk about screening for multibaggers, things to look at on stock reports, things to look at using the stock screener. And beyond that, we're going to do another webinar, like a dedicated Q&A. We're going to roll up a lot of the questions you guys have all asked, and sort of, Megan and I are going to really kind of go over this and talk in depth, and it's going to be very open, and hopefully that will be very useful to you all. And then in the new year, we're going to release watch lists. So this will include some of the standard portfolios that I know many of you will know, but also some watch lists to try and find potential multibaggers of the future. Now, you can really help here as well. We are a community, and there are you guys are probably far better stock pickers than me. So if you've got good ideas, please do share them with us. We will help your potential multibaggers, spread the word on them, and also just to be able to sort of look at them and challenge the community to think about them, challenge ourselves to research them more as well. And we really are a team game at Stockopedia. It's, there's so many of you on the discussion board every day sharing amazing insights. And our editorial team is first rate. Paul, Graham, Roland, and Megan, and Keelan, and all of us who do writing on the site. We've got lots of ideas and really want to kind of roll this up. It would be really, really great. Now, also, do remember that this is a really opportune time in the market. I was digging through our archives and I came up with this chart. Actually, Ollie did, who works with me. This is the FTSE small cap index, and this is the median PE ratio of all the stocks in that index. And it only goes back to 2016 in my archive data, but you can see that there's been this big decline in this is more quality small cap names because they're in that index, but they went down to a very, very low PE ratio. They're still only around a PE ratio of 10. So there is a lot of value out there in the market. And I think it's a really opportune time for people to be looking for potential multi-baggers of the future. So, do go, and this is a great time to be stock picking. So I know I've whizzed through a lot. I'm sorry for the technical glitch at the moment. I don't know what happened there. I think it might be the platform. But anyway, I've managed to get through it and get you all reconnected. So really, really glad. We will be sharing out these slides. I'm going to do some Q&A. And I also, in this deck, before I kind of sign off, we've got profiles of the top 10 multi-baggers. So, little just one-page sheets on JD, Games Workshop, YouGov, CVS Group, Burford Capital, 4Imprint, Judges Scientific, Jet2, and SafeStore and Renew Holdings. We've also got some recommended reading, some of the books I was talking about here. And I've also got an appendix, which I think is really, really good, which shows you the 19 micro caps, which actually did as well or better than the 10 50 million market cap companies that we have published here. And they had a median market cap of only 5 million at the start, but there's some great companies in there. And some of them are lots of lessons to be learned there as well. We will be sending these out. And also the top 10 mid and large cap multibaggers, excluding JD Sports, which did very, very well too. And there's many of the same themes in here, like Greggs, another kind of big brand, high street retailer, London Stock Exchange, Ashted, Halma, Diplomat, really brilliant businesses in that mix. But before we do all that tomorrow, I wanted to kind of like throw it open to Q&A. Now, actually, some of you have actually sent a bunch of questions, which actually I do need to open up. And some of the things were, look, I'm very, very aware of the survivorship bias in this set. I think one of the great questions asked is, how many shared these sorts of traits, qualitative and quantitative, but didn't actually multibag? And I think that's a really, really good question. And the thing is, actually studying the companies that fail, there's so much merit in that. And maybe that's a good chance for a future study. And if you actually have any names that you would like us to kind of investigate, please do share them, because it's a great opportunity for us to do more educational content and have a think about them. Thank you so much for the comments, by the way. It's really, really, really nice of you all. If you want me to kind of go back and, look at some of the slides again, please do let me know. And but as I said, the video series is going to be, very valuable for everybody. So I'm going to dig through some of the questions that you guys have actually been asking. So what I might actually do is share another screen. I might actually just go out of this for the time being and actually pull up Stockopedia, because I'm having some good questions like about how do you screen for relative strength or find relative strength. And I'll just show you this. I'll pull up Games Workshop, and relative strength we publish on Stock Reports actually here. As the 1 year relative strength. In the literature, 1 year and 6 month relative strength are actually kind of the most predictive of future returns. And you can also screen on it. So, you can go in the screener, click new screen, and you can, screen for relative strength. Just type in relative strength and you can click it and choose your time frame, 1 year relative strength, and screen on it like that. So, I find that very, very valuable for finding kind of winning shares. So anyway, let me have another look. How do we, there's some great questions coming through. How do you identify at an early stage that Jet2 has an advantage in a crowded market? Now, I've in many webinars, I've talked about Jet2 Dark Group. It was flagged in a great FT piece about, I think it was sort of David Stevenson screening for shares that got away. And he basically had this great piece where he used Stockopedia. I can't find it at the moment. But anyway, he wrote this piece way back in sort of 2013 about Dark Group as it was known then. And he flagged that it was like, I think it was the top of our screen of screens. It was the most highly screened stock and also had a 100 stock rank. And he flagged that it was like, really, really great on so many measures. So it still got a high rank, actually, Jet2. But way back here then, it had a very high rank and it had doubled in that time frame. And he said, I missed this one. And it was so disappointing to him because many of the measures had suggested there was something going on here. It was really, really cheap on so many measures. It was growing, et cetera, et cetera. But everybody thought Dark Group still had this, I think, a logistics firm called Fowler Welch that it eventually divested. And, I think this is where really qualitative investing comes to the fore. If you're a stock picker and you're doing that stock picking, you're doing the research, it's how you can really figure out that companies are changing their business models. Actually, very well done. Dominic Williams has shared the link to that article. It really is worth a read. And if I click it, I'm not sure if I can, but anyway, you can have a read of that. Now, I would say one of the hobbies that we all have is like watching Netflix or, Apple TV. If you can swap that indulgence for watching company presentations, there are so many now out there on some fantastic platforms, and many people we know in the community run interviews with CEOs. Company presentations are continually going out, And, that has actually become increasingly one of my hobbies, is watching company presentations. Even in the last few weeks, I've been watching presentations from Watches of Switzerland, Altitude, Ultimate Products, just had a great breakout. Sorry, it's changed its ticker. If you actually do go and look at these company presentations, you can look management in the eye, you can actually get a real sense of what's really going on in these companies. And they did this sort of presentation here, and it's just spiked up. It's another high ranking share. And that is how you can really get a sense. So, try changing your hobbies, make them into more profitable hobbies. It's surprisingly enjoyable. There are many good presenters for company results. And especially if you start on Stockopedia, get shares that fit the traits, go on and actually watch presentations. It's such a really good rolling habit to have. So anyway, I'm going to crack through some more of these questions, and let me see what else we've got. There's lots of questions on screening. As I said, I'm going to do those in the sort of masterclass series, and more questions about those that didn't multibag or even collapse. I mean, I would say, look, we've got this fantastic. If you search for books, profit warning, Stockopedia, right? We've got this book on the profit warning survival guide. And we did this great research study on this a number of years ago, and I really recommend it. I think maybe Lawrence shared the link earlier, but it's such an interesting case study. One of the things, as I said, is that we found in this research that it was only the highest profitability stocks that you wanted to continue holding after a profit warning. And really that's in the ilk of, for example, Judges Scientific, that let out a couple of profit warnings in the study period. And, these sorts of multibaggers, they're not immune to a profit warning. And, even in difficult market periods or pandemic and so on and so forth, you might find that companies have to kind of warn on profits, and that's perfectly natural. And it doesn't necessarily take away from the investment thesis. And I think also it's how companies rebound from profit warnings that it also shows have they got really, really good management. Do you monitor high scoring stocks? Yes, of course we do. I mean, sorry, I'm just going to, I know I've talked about stock ranks in this webinar, but we've done a lot of work on our stock ranks over the years. And yes, high scoring stocks. Somebody's asked this, and I just thought I'd reiterate here that this is showing the performance history of the stock ranks over the last decade. And we have this in multiple regions, and the high ranking shares have returned about 210% since inception, which is now, I think, about just over a decade. So that's a very, very significant period and significant return. And low ranking shares have significantly underperformed. We found that high ranking shares have returned about 11% annualized over that period, whereas low ranking shares of 0 to 10 decline at a 17% annualized rate. I often say this amazes me still. I'm baffled by it. And it's the same theme that you find in all the academic research. Good, cheap, improving shares have a tendency to beat the market, whereas junky, expensive shares underperform. It's not rocket science. This is simple kind of actuarial approach to the market. And I'm really glad to see these multibaggers share a lot of these themes. Of course, low-ranking shares can do exceptionally well. In fact, Ocado, I think it was not quite in the list of the top 10 large caps, but Ocado actually performed extremely well through a lot of the study period. And it's crashed a huge amount too. But you do get shares like this that have very, very low rankings that go on these enormous tears. So you can, of course, do very well in more speculative, low-ranking shares, but there's much, much less of them. I've got we're going to be releasing a big study on the stock ranks in future. But I'm not sort of pretending that you can't make fantastic returns in low-ranking shares. You really, really can. And many biotech shares have done very well. But it's really interesting that over that long time period, the good will out. That these multibaggers all shared some traits. I would love to have an AI-backed multibagger predicting screen too. In fact, I think there is such a kind of pot of gold in trying to analyze the unstructured, what I call unstructured data in news, and actually trying to wheedle out all of this information that's in the news flow and trying to sort of get that into our rankings as well, which I think is such a great opportunity. Any recent IPOs that have bombed recently worth looking at? Crikey. Well, we've got this fantastic IPO research that Keelan did. If you Google that as well, I think if we've got that to hand, do share it, guys, because the IPO research is really interesting. We found that on average, the UK IPOs over the last kind of 10 years have done very, very, very poorly. And I'm hugely critical of private equity and venture capital in this country. I think they use the stock market as a dumping ground to try and get their exits. And I think it's done in a, it's very natural. There's a pool of buyers that kind of have to buy because, the funds have to go and buy overvalued shares. But we've seen it again and again. I'm trying to think of one. You've had your, isn't Deliveroo, for example, one that I don't know if that's bounced back. I haven't looked at this in ages. Actually, it has recovered quite a lot. No, it hasn't. It floated at kind of 280 and came down a lot. But interestingly, look, the stock rank is improving there. I don't know much about this share, but I think there's something going on there. I don't know. I use it all the time, but it just keeps losing money. I don't like shares that lose money all the time. It just, it's an immediate turn off for me. And I think all the lessons of this study show that you don't need to gamble in unprofitable shares to do very, very well in the stock market. And there we go. Thanks, guys, for all the compliments. I'm looking at Q&As. Risk is not specifically covered. How do you rate a company that reports in a foreign currency when growth may only be due to FX fluctuations? I think that is a very, very good point. And I think it's an improvement that we are keen to make in Stockopedia, is to actually break out a lot of the international revenues into their own line items and actually help you screen on it. So I wish I had the answer to that. I don't have the answer, and I'm not going to pretend I do. Yes, managing to keep holding when the price starts to drop is the hardest thing. How do you know if it's a blip that will result in a recovery or a collapse? And I think I will try and cover some of that in one of these masterclass videos. It is definitely something that I think we need to kind of, get good answers for. But I think business model analysis is really one of the keys, and also looking at that quality rank. As I said, in the profit warning research, that's what we found. If I zoom in a bit and sort of track back to 2016, I believe that Judges Scientific from our research did a couple of profit warnings in 2016. I think there's probably one there on that date. And it did bounce back. And, I think we found that higher quality shares have a tendency to bounce back much, much more strongly. So, that is one of the things to look at. Profit warnings do not mean that a company is going to go and dive into losses. It just might mean that they're having less profits. And less profits means that the P multiple needs to contract. If the earnings drop, the price often has to contract for the P multiple to be the same. And you've got to kind of look at the management. Do you trust them? Are they good capital allocators? Do they have a moat that they're trying to sort of build out in the company? Do you believe their story? It does take judgment. I'm not going to pretend that it doesn't. Yeah, I know. Where are all the women investors? Rebecca, we need more like you in the investing. I think there is it's definitely true. You see it also that there are a lot more men who do the investing for families. And actually, interestingly, there's been loads of studies that show that actually men tend to be, men tend to trade more. They tend to be make very rash decisions. And there's lots of kind of stories. Like I think there's one about a guy who went into, he came back home and he said, I've been investing in this fantastic company. It's this amazing new technology and they're going to do amazing things. And the wife said, oh, that's amazing. I've been shopping at this new store. All my friends are shopping there now. And interestingly enough, like you get so many kind of insights just from retail and so on. And I don't know whether that's one of the reasons that women do tend to make better investors than men, but not enough do it. And of course, I think in that story, the retail shop was like Gap or something, and it absolutely flew, and the tech stock bombed. And I've been victim to buying tech shares that I thought were going to kind of change the world, and they didn't. I think one of the early ones I bought. I remember my brother bought a share, and it was and he convinced me into it. And they were going to do like flat panel. The promise was like you're going to have wallpaper, which was speakers. It was ridiculous. Anyway, it didn't do very well. So I think I would love to find ways to get more women investing. Obviously, we've got Megan championing it here. Is a wonderful, wonderful analyst and wonderful at her knowledge of investing and in terms of compounding quality and in terms of really looking for those kind of, excellent, really international multi-baggers. And, she's got a great platform here. But I mean, we do need to get sort of more women in investing. I completely agree. And also get that message out that they tend to be better investors than men. So Simon, he's asking a good question. How many of these were highly speculative back in 2013? Well, I mean, that's really the point. So on Stockopedia, we have these risk ratings, which is a 5-point classification, a classification of shares from conservative to balanced, adventurous, speculative, and highly speculative. And interestingly enough, in these shares, they actually weren't speculative or highly speculative at that time. I think I've actually got a portfolio of top 10 compounders here, of these top 10 compounders, and you can see the risk rating here. And a few of them are still speculative, which are the more volatile ones, YouGov, Jet2, Burford Capital, but many of them are adventurous or balanced. So adventurous being the kind of the middle grade of volatility in the market. And actually, as I showed you in that chart earlier, they actually have become a bit more volatile over time. So I don't think they necessarily had very speculative risk ratings at the time. And this is a question I love. I want to ask this of all of you. Which of these 10 baggers are going to be 10 baggers in the next 10 years? Sorry, they weren't all 10 baggers in the last 10, but which of these has got the potential to go on to be a 100 bagger or, to 10 bag from here? And if you do have the answer, share it in the chat. We will actually go and download the chat after the webinar is over. And, we will have a real mind through what you're saying. And I think do go on the community. You can go on the community and please do post the thread or talk about it in the small cap report, because there's lots and lots that could be said here about, sharing it, creating a thread, get the discussion going about all these kind of compounders. I'd love to know. Maybe some of the micro cap stocks that I showed you in some of the slides will actually go on and, 10 bag again from there, because lots of these actually have sort of turned into kind of really good companies. And, we owned in our investment club several of these, like Best of the Best and, some of the others. And, lots of these are still on kind of quite low market caps. Best of the Best have actually been bought out now, but many of these have actually gone on and they're really good little businesses. Billington, I think it had a good announcement this week, and Water Intelligence. Lots of these. Spectra Systems gets a lot of love, a really kind of high earnings and revenue visibility, and so on and so forth. So maybe some of these will go on in 10 bag in the next 10 years and become real giants. But I'd love to know. You guys actually probably have a lot more knowledge than I do. And anyway, so should you rebalance or hold when your multi-bagger is much bigger than your other holdings? I think that's a great question. Now, many of you will know from the NAPS portfolio, I've a great advocate of rebalancing. And I do think it's a very, very effective approach when you have a lot of, especially if you're actually not doing, if you're not a stock picker, if you're more of a systematic investor, then rebalancing your portfolio on a consistent basis is a great way to kind of harvest the market rewards. Those sorts of rewards I was talking about from the stock ranks. So, if you're wanting to kind of capture that 90 plus stock rank return and compound your portfolio over time, it's a great way of doing it. But if you are someone who is, you've got a big holding in, let's say you've done fantastically well and JD Sports is 22 bagged and it originally was 10% of your portfolio and you had 10 stocks and it goes in 22 bags and your portfolio is tripled and huge amount of your portfolio is now in JD Sports, maybe 3/4 of it is now in JD Sports. I can imagine that's going to keep you up at night. I always think it's good to kind of sell to the sleeping point, especially, if you're in an ISA, you don't have to, or a SIP, you don't have to worry about sort of capital gains tax. You can actually, you can crystallize gains without too much stress and, perhaps invest it in others. You do have to think about your overall risk. And I have seen some investors, who've been, I think, the community are brilliant about sharing what they've done and what they got wrong. And, I've seen people have like 30, 40% in their portfolio and get it wrong. I did it myself. Global financial crisis. I think I'd 5-bagged on a little company called RC Group. And it was, I think, more than 60% of my portfolio. And I'd gone very aggressive in a couple of Chinese AIM stocks. I learned my lesson. And I'd made such a great return, a lot of money. And I thought they were going to go on and on and on. I didn't dare sell. And of course, I ended up selling at, I think it got to 140p. I managed to get out at 60p. It eventually, I think, delisted at about 1p. So I got out because I actually was buying a house. And I think I would have hung on. It was, there's so many lessons there. So, definitely that company didn't have a moat. And I should have realized when I bought software and biometrics, I tried to get into my computer. It locked me out of my computer. I could never get back in. That should have been the red flag to sell the share. So you can do your own research. So anyway, rebalancing, sell to the sleeping point. I think it's a great motto. I did a good piece on selling and keeping your losses small recently. I want to do a piece on when to sell when you've got profits, and I will follow up on that at some point in the coming weeks. That's it. So great. Yes, I know. 100 Baggers. Someone is saying this book, taught by Thomas Phelps, 100 Baggers. Do get a copy. No commission. I just think it's a really good book. And Christopher Meyer actually. Oh no, you were actually mentioning Thomas Phelps, but this was inspired by Thomas Phelps's 100 to 1 in the stock market, but this one's called 100 Baggers, and it's a bit more modern, updated version of that. And there's a few book recommendations in the deck that I do think you should look at. Build a library, build a great library. So anyway, there's going to be a more extensive Q&A in this dedicated questions and answers webinar. We're going to do a bit more of a structured view, and if you have any other questions, do send them in. Do send to support@stockopedia.com or use the green button. Thank you all so much for your time. I mean, it's been, I'm trying to keep it a bit kind of shorter these days. So we've had a good hour and 20 minutes. And as I said, there's going to be these videos. I'm going to record them. I'm going to try and keep them to sort of about 45 minutes each. And there will be 3 of them. And then we will have this Q&A webinar. And I'm very happy to go and sort of demo things on the site if you want to kind of go and dig around. And you've got these watch lists to look forward to as well. And hopefully we'll have a recording of this. There was a technical glitch, so if the recording was interrupted, we will either re-record it or whatever. So anyway, thank you so much for listening. I'm going to let you all go now. Let me just see if there's any final questions. But anyway, thank you so much. Really appreciate all of your questions and all your engagement. Brilliant to do this work. And we'll be doing a lot more content on this in the coming weeks, by the way. We're going to do lots of writing. We're going to do a lot of, we're going to do a lot of blogs. We're going to do newsletters. We're going to do videos. So lots of good content to come on this theme. And hopefully these lessons will be referred back to like the profit warning research was in the past. So thanks very, very much, everybody. I'm going to let you all go, get to your supper, and take care. Do go and find multi-baggers. Do go and share those ideas with the community. Much, much appreciate it. Take care.